Okay, so you want to own a car dealership. From the outside, it looks like one of the most profitable businesses on the planet. Every day, customers walk in ready to spend $30,000, $50,000, or even $100,000 on a single purchase. The parking lot is filled with shiny new vehicles worth millions of dollars. Salespeople celebrate another delivery. Finance managers close another deal. Manufacturers keep sending fresh inventory. On paper, it feels like money is pouring in from every direction. But here's the twist. A dealership can sell hundreds of cars every month and still struggle to make meaningful profit. Read that again, because the real business isn't selling cars. In many cases, the vehicles are simply expensive inventory moving from one balance sheet to another. Every unsold car quietly costs money. Interest keeps accumulating. Depreciation never sleeps. Incentives change. Demand shifts. One slow month can erase the profits from several good ones. Now the mental model completely changes. The dealership isn't just competing to sell automobiles. It's managing financing costs, inventory turnover, customer lifetime value, service revenue, warranties, insurance products, and relationships with manufacturers all at the same time. The cars attract customers, the financing often pays the bills, and the service department frequently keeps the entire business alive. Once you understand that, you stop seeing a car dealership as a showroom. You start seeing it as one of the most complex financial machines in modern retail. Not all car dealerships operate the same way. People often imagine every dealership as a giant glass showroom filled with luxury vehicles. In reality, the industry is divided into several very different business models, each with its own economics, risks, and capital requirements. At the entry level, you have independent used car dealerships. Opening one can require anywhere from $200,000 to $1 million, depending on inventory, location, and local licensing requirements. These businesses have more pricing flexibility because they are not tied to a manufacturer, but they also face higher inventory risk and must build customer trust from scratch. Next are franchised mainstream dealerships representing brands like Toyota, Honda, Ford, Chevrolet, Hyundai, or Nissan. Purchasing or developing one often requires several million dollars in total investment. The manufacturer controls branding, facility standards, training, and many operational requirements. But franchise recognition brings steady customer traffic and access to new vehicle inventory. Above that are luxury dealerships selling brands such as BMW, Mercedes-Benz, Lexus, Audi, or Porsche. These locations demand premium buildings, highly trained staff, expensive diagnostic equipment, and an exceptional customer experience. Initial investments can easily exceed $10 million, while operating costs rise just as quickly. Finally, there are dealership groups that own dozens or even hundreds of locations. Instead of relying on one showroom, they spread risk across multiple brands, regions, and revenue streams. At that scale, the business stops looking like retail and starts looking like a sophisticated investment portfolio. Now comes the part that surprises almost every first-time investor. Buying the dealership is only the beginning. Keeping it alive is where the real money disappears. Start with the property. A modern showroom, customer lounge, offices, repair bays, and a large paved lot can cost several million dollars before a single vehicle is delivered. Then comes the inventory. A franchise dealership may need tens of millions of dollars worth of new vehicles sitting on the lot. While many of those cars are financed through floor plan loans, the interest expense keeps growing every day a vehicle remains unsold. And that's only the beginning. Manufacturers require specialized tools, certified diagnostic equipment, software subscriptions, branded signage, employee training, and strict facility standards. Miss those requirements, and your franchise agreement could be at risk. Then come the operating expenses. Payroll for salespeople, technicians, finance managers, service advisors, accountants, and administrative staff. Property taxes, utilities, insurance, security systems, advertising campaigns, digital marketing, customer relationship software, warranty administration, environmental compliance, parts inventory, routine building maintenance, loan payments. None of these costs stop simply because sales slow down. Imagine the dealership as a giant airplane sitting on the runway. Every minute the engines are running, fuel is being burned, whether the plane takes off or not. A dealership works much the same way. Every day without enough vehicle sales or service revenue quietly consumes cash, making efficient operations just as important as selling the next car. Now, here's where most people completely misunderstand the car dealership business. They assume the biggest profits come from selling new cars. In reality, new vehicle sales often generate surprisingly thin margins. Competition between dealerships, manufacturer pricing, incentives, and online price transparency leave very little room for massive profits on the vehicle itself. So where does the real money come from? First, the finance and insurance department. When a customer finances a vehicle, purchases an extended warranty, gap coverage, maintenance plans, or other protection products, the dealership earns high-margin income that can exceed the profit made on the car itself. Next comes the service department. A customer may buy one vehicle every 6 or 7 years, but they return for oil changes, tire replacements, brake repairs, diagnostics, batteries, scheduled maintenance, and warranty work for years. That steady stream of repeat business creates predictable cash flow long after the original sale. Then there are parts sales, certified pre-owned vehicles, trade-ins, and reconditioning. Buying a used vehicle at the right price, preparing it efficiently, and selling it at market value can produce far healthier margins than many new car transactions. Think of the dealership like an iceberg. The car sale is the small portion everyone sees above the water. Below the surface sits financing, warranties, service, repairs, parts, and repeat customers. That hidden section supports everything above it. Sell one car today, and you might earn a modest profit. Keep that customer returning for maintenance, repairs, and future purchases over several years, and the lifetime value becomes many times greater than the profit from the original transaction alone. So, if dealerships have so many revenue streams, why do some still fail? Because this is a business built on leverage. Most dealerships finance a significant portion of their inventory. That works well when cars sell quickly. But when demand slows, interest expenses keep growing while vehicles lose value and consume valuable lot space. Cash flow tightens, discounts increase, profit margins shrink. What looked like a healthy balance sheet can deteriorate surprisingly fast. Expansion creates another risk. Many owners borrow heavily to acquire additional franchises, renovate facilities, or purchase expensive real estate. If sales fall during an economic downturn, those fixed debt payments remain. The business suddenly has less flexibility, and every slow month becomes more dangerous than the last. A good example is Carvana. During the surge in vehicle demand, the company expanded aggressively, purchased inventory at elevated prices, and took on substantial debt. When the used car market cooled and financing costs increased, profitability collapsed, forcing the company into a major financial restructuring to stabilize its operations. Another example is Pendragon, which spent years dealing with changing consumer demand, rising operating costs, and pressure to improve returns before ultimately agreeing to be acquired after prolonged financial challenges. The lesson is simple. Selling more cars does not automatically create a stronger business. If inventory turns slowly, debt grows faster than cash flow, or operating costs outrun gross profit, even a dealership with millions in annual revenue can find itself fighting for survival. So, after everything we've covered, is owning a car dealership actually a good business? The answer is yes, but probably not for the reasons most people think. A well-managed dealership with disciplined inventory management, a profitable finance department, and a strong service operation can produce healthy long-term returns. In a realistic scenario, net profit margins often fall between 2 and 5% after operating expenses. Exceptional operators with premium brands, efficient cost controls, and high customer retention may occasionally achieve margins closer to 6 or 7%, but those results are far from guaranteed. That may not sound impressive. Until you remember the scale, a dealership generating $100 million in annual revenue can still produce several million dollars in annual profit, even with relatively thin margins. The key is not maximizing the profit on each vehicle. The key is maximizing the lifetime value of every customer while keeping inventory moving and expenses under control. The best dealership owners think like bankers, retailers, and logistics managers at the same time. They constantly balance financing costs, customer satisfaction, manufacturer relationships, service capacity, and market demand. Lose control of any one of those variables, and profitability can disappear faster than most people expect. So, the next time you drive past a dealership packed with brand new cars, remember this. You're not looking at a business that sells automobiles. You're looking at a business that manages capital. The cars are simply the vehicles that move the money.